Hi, David. Thank
Hi,
you
sir.
for taking the call.
You bet.
You've said a lot of things that have reviewed things that I'm familiar with, and a lot of questions have already answered my questions. Can I just review one thing that I remember from the newsletter, in that gold is not in a bubble because less than 1% of the population has invested in gold and metal or silver? Is that still true?
Yeah, great question, Carrie. I don't think we know exactly in terms of people's ownership on a global basis what percentage gold makes up, and certainly there's countries around the world where that number is going to be much higher. When you get to India and when you get to China, you'll find a much higher percentage in terms of someone's allocation and the general public who likes the metal and wants to own it. I think it's fair to say that where we started in 2001 or 2, at the beginning of the bull market in gold, it was probably 1 to 2% at that point, and my guess is we've probably doubled the audience to 4% at this point in terms of the U.S. public. And that can be very deceiving because you see all the ads on television and you think, wow, it's everywhere. People are buying it, must be buying it. We've been in the business for 40 years. We have certainly seen an increase in traffic in the context of this bull market, and we've certainly grown our client base in the context of this bull market. But nothing like we did and what we will see as we get to the final stage of the bull market in precious metals, where the general public is actually buying. We know what that looks like. We know what it looks like to have our entire staff stay late 3, 4, 5 hours after closing time just to finish filling out buy tickets, to finish inputting trades, because the volume is immense. We know what it looks like to have people send us hundreds of thousands, millions of dollars, and just say, we wired you funds, buy us whatever you can buy. With people that we've never even had a relationship before, we don't even know, and money's just showing up. We are so far from that, Carrie, so far from that. We haven't even seen the beginning stages of what we would define as sort of the last stage of the bull market, where you'd see a parabolic move. So being in the market and knowing kind of what the internal dynamics are psychologically and in terms of traffic, we've been in a bull market. We just haven't gotten to that last stage. No, gold is not in a bubble. Absolutely not. I would guess that we will move from 4% of the general public in the United States owning it. I think ultimately we could have 10 or 15% people who have some exposure to the gold market. That's a big increase. It's not dependent on the U.S. market. As we mentioned earlier in talking with Joe, this is a market that's largely driven by Asian demand, and we're going to be playing catch up. We're going to be playing catch up in terms of on the street demand for gold. Long and short, we're not in a bull market. We're not in a bubble. In the last stage of this bull market, it must be getting late.
It is getting late, and I just had one part. The second part of my question was about triggers. You had mentioned triggers. And we live in Michigan, and Detroit is on the brink of bankruptcy, and the administration's talking about dipping into the pension funds of their workers. And Obamacare is going to kick in even more severely on January 1st. Would those 3 things constitute 3 triggers or a cumulative trigger for a bigger step in the recession direction?
Well, not only that, Carrie, but also a bigger step in terms of loss of confidence in the system. And that's I think, your major step forward in terms of the price of gold, getting us to 2,500, 3,500 as an interim step to kind of a final move higher. There is going to be a snap in confidence, and it'll be when people's guarantees are called into question, when people's most basic, the things that you've just always counted on. I mean, and this is why Cyprus was so important this year. No one thinks that having deposits at a bank means that your assets can somehow be at risk, because it's just a bank deposit. Who knew that you could be bailed in? And yet we had a bail-in in England just this last week, following the bail-in that we saw in Cyprus. So, depositors are being redefined as an opportunity to fix the balance sheet. And that's unfortunate. That is a part of what drives, ultimately, the gold market to its highest levels. It's a crisis of confidence. It's a crisis of confidence in the dollar. It's a crisis of confidence in social guarantees. It's a crisis of confidence in our leadership. And so you're wise in pointing out that compromising a pension payment or capping what's going to be contributed to a pension, it is significant. It's very significant, not because X number of people are going to be hurt by it, but because it's changing the way people think about the system, and it is causing them to call into question whether or not there are as many guarantees as they thought there were.
Okay, because the reason I asked is because those things could happen overnight. They're slow coming. We're reading about it in the paper all the time, but once it happens, it would be an overnight panic for those people in the pensions, and wondering what to do, with their investments.
Well, and that's one of the reasons why the notion of trading out of metals is so important. You don't want to get too cute with trading in and out of metals, in large part because what drives the metals is something that is uncontrollable and unforeseeable. That trigger, whatever that trigger may be, which exacerbates the crisis in confidence. And as that sort of gains a head of steam and moves out of control, it's the same. The corollary to the gold market and sort of this confidence measure, or lack thereof, is the currency itself. When you think of a hyperinflation, it's not a monetary event where they finally printed $1 too many and therefore we're in a hyperinflation. It's a psychological and sociological moment in time where people stop believing in the currency. And it's a moment in time, 1 nanosecond, and you go from one reality to a completely new reality. And you can't time that. You can't get in front of it. I mean, it literally is like the accident, a car accident, thinking that you can somehow put your safety belt on in the middle of the accident. You cannot do it. You cannot do it. The physics are against you. And to try to position, again, trading around this doesn't make any sense. It doesn't make any sense.
Thank you very much for your time and for answering all the questions that you did. Thank you.
Thank you for joining us, Gary.
Bye.
Well, thank you, David. I enjoyed this evening, and I'm sure all your listeners have too. My question concerns a book I've been reading by James Reichert about the currency wars, and I understand, I guess, the term currency wars, but I really don't know what that term means in terms of investments in the future. And it seems to me like the wars are different countries debasing their currency and different countries creating zero interest rates and things like that to depreciate the value of their currency. But once they raise or drop their interest rates to zero and they have no further way to do anything there, then they just print a bunch of money. But I guess I don't understand what countries are involved and where this is all going.
Every country is involved, and here's think about global GDP, all of the economic activity of the world. Think of it as a big pie, and now imagine that everybody has their slice of the pie, but also to some degree everyone would like a slightly larger piece of the pie. And there's only so much to go around. Global GDP, it is what it is. Yes, we can grow it. But here's the problem: when you move into a global recession, you have a shrinking pie, but you don't want the total size of your piece to shrink at all. So it makes you look around and say, well, maybe I can steal someone else's slice of the pie or marginally squeeze them out. You do that through currency operations. You do that by doing what the Japanese are doing. When you take your currency down 20, 30%, it makes the manufactured goods in that country more affordable in the open market. And so what you're doing is you're trying to elbow out your competitive manufacturers. And again, it's just a pie. You want a larger piece of the pie. Or you want to maintain what you once had because you know there's social ramifications, political ramifications for not keeping your economy on track. So if the world economy is shrinking and you want your economy to stay on track, then someone else has to pay the price for that. And you can do that by abusing your own currency and capturing market share from someone else. So everyone who's now in a defensive posture saying, hey, wait a minute, the Japanese are creating their widgets and they have a competitive trade advantage. What is that going to mean for us? That means that our widgets are going to be too expensive and nobody's going to buy them. That means we're going to have to fire people. That means that we're going to have an unemployment issue. And that means we're going to have potentially either political destabilization or at least the powers that be aren't going to be able to maintain their position of authority. And so what do those in a position of authority do? They say, well, if we've got to sell our widgets just like the Japanese or anyone else, why don't we devalue our currency and make our widgets on par? We think our widgets are better, so maybe if we just have it on par, devalue our currency to the point where our widgets are better quality and they're the same price, we keep our market share. Or maybe they're tempted to elbow the Japanese out. Maybe they're tempted to elbow the Malaysians out. Maybe they're tempted to elbow out the South Koreans or the Germans. This is the nature of a currency war. It ultimately is politicians who want to preserve their position of power, and to do that are willing to keep their constituencies happy and are willing to tempt fate in the currency markets, devaluing, debauching, printing, creating an inflation, if you will, in order to maintain that trade advantage. So very basically, if you can just imagine that pie, everybody wants the same size slice they used to have, and in a recessionary period, everyone's slice is declining in size. So you do what you can to survive, you do what you can to maintain the status quo, and this is the nature of what they call beggar thy neighbor currency policies. You don't care what happens to your neighbor, you just want to take care of yourself. That's the nature of the currency war.
How does that tie in with the United States losing its reserve currency status? Because we're doing so much quantitative easing, people do not want the dollar to have that most favored nation status, and so therefore, in this whole currency war, it looks like the United States is going to lose, right?
Well, I don't know. I don't know if we'll lose. Our reserve currency status is something that is, I think, partially an issue of resentment and partially an issue of jealousy, in the sense that, when you have reserve currency status, you gain a couple things with that. You gain a lot of foreign policy clout. You gain a lot of subtle influence, and you certainly sort of entrench your manufacturing interests and business and banking interests by everyone around the world having to have your currency on account in order to do business. So it reinforces your importance. And that's something from our perspective, something to be kept. From their perspective, something to be desired. And so this idea of the king dollar being dethroned is very important. To everyone else in the world, they would like to see us lose that status. But they don't need to do that through currency devaluation. And I think this is, when we talk about currency wars, I think there's a separate theme that has developed over the last 3 or 4 or 5 years, which is more important to us losing our reserve currency status than what you find in this sort of beggar thy neighbor policies, which virtually all central banks are involved in. It's just a question of whether or not they're bold enough, like the Japanese, to say, hey, what's good for us is good for us, and we don't give a rip if it's not good for you. Then there's the more subtle, hey, maybe you shouldn't be doing that even while you are doing it. So two camps, the ones that say they're doing it and are doing it, the ones that say they aren't and still are. That's your currency war issue. The bigger issue in terms of us losing reserve currency status is tied to the currency in which business is transacted. So you've got oil, which is traded in dollars. You've got invoices between two countries in Asia which are settled in U.S. dollars. And it forces the banking institutions and the financial system on the other side of the pond. This could be, again, two companies, let's say, for instance, one in the Philippines and one in Malaysia, and yet they're transacting business in dollars. And so we're conveniently the middleman in the transaction, and what is being replumbed is the flow, the future flow of capital for invoice settlement, for transaction settlement, not just in currencies, but between businesses. And that is what's being undone right now, where we had sort of all the plumbing which required U.S. dollar flow, and now there's another set of plumbing which is being put in place, and it circumvents the U.S. dollar. We're losing that middleman status. That is a separate issue and is going to topple the position that we have. Doesn't mean we're not going to be important in the world of currencies. It just means we won't be as important, and we'll begin to lose, again, foreign policy clout and a lot of other things that go along with influence in the financial system and whatnot, given the role of the dollar.
As that plays out, doesn't that, though, lead to a currency war? In other words, the United States wants to hold its reserve currency status, and China wants the reserve currency status, and so that's really maybe another type of a currency war? The pie thing, there's also this war going on between reserve currency status?
Robert, I think that's where you flirt with moving from a currency war to moving to an outright war.
Okay.
Where we and this is one of the reasons why you can't completely discount the U.S. dollar. We may have a bunch of buffoons in D.C., and I don't think anyone listening would argue that point. Maybe there's a handful, who would stand out as non-buffoons or less buffoon-ish, if that's a word. We have the greatest number of tanks and bombs and guns than of any country in the world. And when push comes to shove, when we have exhausted every other measure, we're still going to push our weight around on the battlefield. And this is where, you can't sell the dollar short to nothing. Do I think we'll see a devaluation? Yes. 30, 40, maybe even 50% from here. 30 to 40%, very comfortable seeing those numbers. Not comfortable seeing them, but expect to see them. But are we talking about the eradication of the dollar? I don't think so. And that's in part because we will fight for our survival in the world of economics and business, even if we have to take that fight to an Abrams tank, to dropping bombs, there's a lot of our history that we should not be proud of, where money was the motive, and it was not freedom fighting, and it was not helping the good guys and fighting bad guys. It was just pure monetary economic interest. What makes you think we're going to be any different in the future? We will fight.
If that were to happen, and we would actually go into physical fighting, how do you think that would affect gold and silver? I guess that's where I'm going with this whole thing.
The X factor in the gold price is how high do tensions run? Because listen, it was economic variables that took gold to 400. It was geopolitical tensions which took it from 400 to 875. I think it's very reasonable to assume that we have set a course because of our fiscal misdeeds and because of our monetary policies today, which take gold in dollar terms to $2,500, $3,500 an ounce. Anything above and beyond, say, $3,500 an ounce, is because there is a world that is cooperating today which is beginning to degrade. There's greater conflict. There is a geopolitical element, and that geopolitical element, I don't know what the factor is. I don't know what multiplier you take to a $2,500 or $3,500 gold price when you bring, is it a 2 times multiple, is it a 10 times multiple? It depends on what the issue is. Who's at risk? Whose capital is getting ready to be lost? And on that basis, who wants to pile into gold regardless of the price just for the promise of safety? Because things are that bad. So that's, again, where the economists of our day, the money managers of our day, they would say, listen, no inflation, you don't need to worry about gold, who needs it anyways? The CPI just came out with a better number, there's even less inflation, you guys are foolish for considering owning gold. Well, not only are their numbers off in terms of inflation, but they don't realize the other variables, the other extra financial, extra economic variables that have a major influence on the price of gold. And again, you start multiplying. Whatever your ultimate economic number is, we get to gold at 2,000, we get to gold at 3,000. You've got a multiple on top of that, because what comes with economic and financial chaos is ultimately bullying. Bullying. We're bullying someone, someone's bullying us, and real money around the world starts to say, wait a minute. I've seen this before, but I'm going to have to dust off the history books. I never thought it would happen here, but the wealth that I have in this country, I might not get to keep it. The only thing I might get to keep is what I can carry on my back. And all of a sudden, people who derided gold ownership are wishing they had more ounces that they could put into an attaché and walk across the border with, because relationships are changing, because international trade has deteriorated, because the old world and the new world look a lot different as a basis of, or on the basis of this conflict. So, the political element, the geopolitical element, I think this is a future story that will add to the reasons why people buy gold. And it's tough for people to imagine today those circumstances being in place because it's so far removed, particularly for us here in America. In America, we've had it so good. We've had it so good for hundreds of years. We've been able to fight on other people's soil, and we've never had it come here. And that may continue to be the case. But it does impact the way we think in terms of sort of our invincibility. We're not vulnerable. We never have been. Never will be.
I think what I hear you saying is that if that kind of chaos ever does happen, it really may not really even matter what the price of gold is. People may just go to gold and silver just because of the security it provides. Like you said, taking something on your back.
The price does not matter. Yeah. Ultimately, the price does not matter. When people start buying gold on the basis of fear, and it's not just a question of, many of the things we've been talking about tonight, treasury yields, relative to stocks, how does it compare? But when people when people experience an existential threat, then all of a sudden the price of gold is irrelevant, and whether it's 1,000 or 100,000, it's going to be owned. You can't stand in the way of the buyer. Cannot stand in the way of the buyer. And that's, what most market participants don't appreciate is that the power in the repricing of gold comes in its final stage where fear is at an apex. We haven't seen that yet. I hope we don't. I really hope we don't. I hope we can undo all of the questions that we said tonight. I hope we can backtrack and say gold is going to $100 an ounce because, the world's economic pie, GDP, has continued to grow. Everyone's happier. There's no possibility of conflict. It's never happened that way. It's utopian thinking that's gotten us into more trouble and killed more of tens of millions of people than anything else. I think as realists, not as utopians, as realists, we have to come to terms with the fact that there are cycles and things get out of control and there is conflict, and you just don't want to find yourself on the wrong side of these major trends. If you can stay on the right side of these major trends, preserve your purchasing power, preserve your wealth being in real money, then at some point this too shall pass. And at some point you can deploy or employ those same dollars, as it were ounces, towards some productive means for the benefit of your family, for the benefit of your country, for the benefit of your community. So, I'm conflicted. I'm conflicted in seeing higher gold prices because I know that with higher gold prices, we're talking about a world that scares me. When I think about my children, when I think about future grandchildren, I don't want to see higher gold prices because I love them. And I don't want to see the kind of hardship that comes with a higher gold price. On the other hand, it's not that there's some sort of deterministic calculus in play here, but we are dealing with the consequences of bad choices. And I don't know, and I don't believe we can, avoid consequences, the consequences of choices that have been made now for 30 or 40 years, fiscal and monetary in nature, and which have just gone viral on a global basis. So being a realist, not a utopian, you do what you can do for your family, and leave the rest to God.
Thank you. I appreciate what you said. I agree with you.
Well, thank you all for joining us. There may be 2 of you listening or 2,000. I don't know how many people have stayed up this late, but thank you for joining us. Your relationship is appreciated. These are guaranteed to be harder times ahead, and it has nothing to do with the volatility in the gold price. And just know that we stand with you the ways that we can. We'll try to provide information to you on a continual basis and try to provide some insight into what's happening. We view the relationship as a partner relationship, one that extends beyond the day through the generations, and feel it an honor and a privilege to work with you in that capacity. So thank you. Have a good night. Enjoy your weekend. Spend some time with family this weekend, loving on them, and reminding them of how important they are to you. So much more important than anything we've talked about tonight. Thank you for the relationship. Thank you for the trust and the confidence you've placed in our family and in our companies. Wish you the best this weekend. Good night.